August retail sales increased by a surprising 6.4% year-on-year compared with the revised 2.9% in July. Joining us on the desk for more is Sid Vianella, retail analyst at Net Group Securities. Sid, we've been trying to make sense of the numbers. What we're noting is that, yes, it's a surprise, and everybody's been mentioning the fact that what you're seeing is really a lot of up and down in terms of the numbers. There isn't like a trend that's emerging properly that gives you a proper reading of these numbers. What's your view?
The numbers that come out of Central Stats, to me, have, since time immemorial, been rather erratic, to say the least. I mean, we jumped from 2.9 to 6.4 overnight. If you just take the one category, the one that really sticks out, the clothing category, in nominal terms, which is the real money in people's hands, sales supposedly, according to the data, when I say supposedly, I mean this is the data the government's working on, this is the stuff that's provided to it by the retailers, jumped by 21%. But the previous month, the nominal number was a fairly meager, what was it, Annabelle, about 5% or something. I mean, it jumped enormously. I reckon that a lot of this has to do with the retail accounting formula, where retailers work on typical 4- and 5-week accounting months.
I thought you were going to say there's a credibility gap here.
No.
Like Jack Welch.
No.
Says Barack Obama is cooking the U.S. employment
I have
numbers.
a suspicion that some retailers are providing the sales for their accounting month, which may well, in the case of August, have been a 5-week accounting month versus 4 weeks last year, which means that there's an overflow of 1 week into August, and versus only 4 weeks in the month of July. So and I have a suspicion that a lot of it has to do with that.
So what are we to read of the overall condition of the consumer then?
I think you've got to take this figure and you've got to take the July figure and you've got to aggregate the two figures and come out with a blended number. And then the numbers look kind of okay.
Or even a 3-month rolling average.
Or a 3-month rolling.
Safe usually.
No, but if you look at those numbers, the numbers to me are just a normal trend. I don't see any jump in the numbers, and I don't see any deterioration in the numbers. What Nedbank said today in their commentary, and
you contributed.
No, I didn't contribute to that. That's done by the economics department. But I'm just quoting what they said, and I concur with what they're saying. I think these massive above-inflation wage settlements, together with any impact, which of course over time is going down, that's the impact from the unsecured lending, because obviously as the base gets bigger, the percentage growth will get smaller and smaller over time. I think that those two factors have certainly contributed to these numbers. And looking forward, I have no doubt they will continue to contribute to these numbers. I think the big challenge going forward is the trade-off between the even bigger above wage increases that you've just that've just been negotiated with some of the mining industry, and no doubt going to filter through into a lot of other industry as well, versus the trade-off versus the number of jobs that are going to be lost. Because jobs are going to be lost. I mean, I'll tell you something that was which is not in the public domain.
We're breaking news here. We're breaking news.
But it is in the public domain because a participant who's a friend of mine, who manufactures products for the mining industry, told me 2 days ago that Marikana announced last Thursday to him as a supplier they're closing down one of the shafts.
So we're beginning to see the ripple.
The wage increases have raised, obviously, the overall minimum cost of that shaft to a level where long-term it's unprofitable. The shaft is closing, full stop. We haven't seen the beginning of it yet, because there's going to be a lot more of that to come.
I think we're going to invite you to our next debate on Marikana, but let's go back to the retail numbers. Now, let's go to the drivers if we can. One of the big drivers that's been mentioned by the commentary that I've been saying is that you've got the rate cut that came in July, number one. Number two, you've got unsecured lending. You're picking up the same reasons.
You know, unsecured lending, is a little bit of a worry for me, because we're in a situation where if you look at the age analysis of the debtors book, that's starting to worsen. In other words, the percentage of the debtors book unsecured lending that is current is reducing every quarter. So in other words, people are taking longer and longer to pay off their debts. That worries me because, as we know, a credit bubble is a situation where impairments rise to the point where obviously the market is negatively impacted and the banking sector. So that is a bit of a worry to me. I think that certainly, you know, the strong demand we are seeing for credit in South Africa, which is evinced by the strong supply of unsecured credit, that certainly has, you know, really supported the retail sales figures. But one of the things that perhaps if I could pick up on that you said earlier, one of the things that do worry me about retail sales for the rest of the year is that these illegal strikers are not going to be paid for these days they haven't worked.
Absolutely. They're not going to be paid. Some of them will no doubt apply for jobs because some shops will come back into production. But I have absolutely no doubt that the number of people who are going to be re-employed may well be less than half of those who've been fired. But not only have they just been fired, which means they aren't going to earn money going forward. As Animal says, they haven't earned money for 2 months. Now, what's happened to the unsecured loans? The retailer accounts that have got to be paid, and all the other stop orders and what have you, all that could not have been settled because there is no money around. We haven't, you know, all these things have still got to work through the system.
We might as well talk about Christmas. So what happens to Christmas?
Well, I mean, look, we'll get a good indication of what Christmas sales are going to be like.
Well, it's going to be fewer workers, some of them with less money than they had last year, perhaps no bonuses. I heard the story of strikers at Kumba who are, not strikers, but workers at Kumba who are angry with their colleagues who went on strike because they're jeopardizing their chance of getting a bonus this year.
Correct.
I mean, if what Sid is saying is correct, then, you know, I think things are moving very, very rapidly. And by November, you might just see an awful lot more people out of work.
But I want to give you another perspective that another friend of mine told me, who supplies the mining industry. December, January, traditionally, particularly in gold mining, but I guess it's pretty widespread, are bad months for producers. Because you only work a lot less than the typical 30 days, people go on leave and what have you. A mine that is currently closed, according to my friend, he believes that mine will not reopen until February, because it will not it won't pay the producer to reopen in November and then effectively close down in the middle of December right through to the middle of January. It will pay him just to leave the mine on care and maintenance all the way through until February, which means that we're going to go right through Christmas with no money.
Like Christmas, I'm reading. So would you touch any of the retailers? Is there any value in any of them?
Well, if you look at what happened today, I mean, it's damn difficult to find any value. Mr. Gilmore, you manage a lot of money.
I've been saying for a long time, the price for perfection. Virtually all of them. And there's one that sticks out particularly on a PE of more than 30, and that'll be a PE of more than 40 next week. It begins with a P. And it's difficult to really see the value in a lot of this. And so, look, provided that people keep spending, and provided the growth comes through, and a lot of them, the growth is still coming through, that will support it. But the moment you start seeing chinks in that, then they could be very vulnerable.